Welcome to Key Talking Points.
The podcast that makes learning effortless.
No fluff, no jargon, just clear, engaging explanations.
We break down complex topics so you don't have to.
Let's get straight to the point.
Visit keytalkingpoints.com for more. All right, let's start at the beginning. When we talk about accounting scandals, we're referring to situations where financial reports are deliberately manipulated. It's not just about one rogue employee either. This kind of misconduct can ripple out, affecting everyone from investors to employees and even the broader economy. Now, does that sound dramatic? Maybe, but these scandals can genuinely shake entire companies to their core.
Right, and the thing listeners might find shocking is how it all happens. It's not like someone just wakes up one day and decides to commit fraud on this massive scale. There are methods to the madness, things like overstating revenues or undervaluing liabilities. And honestly, the bigger the company, the messier it gets.
Exactly. Now, broadly speaking, there are two main types of accounting fraud. The first is misappropriation of assets. Picture this. An employee decides to take company cash or even office supplies for personal use. It may sound small scale, but it adds up. And it's not just money. Company data or intellectual property can also be at risk.
Yeah, and then you've got fraudulent financial reporting. That's the real big hitter. This is where management tweaks accounting policies or estimates to make financial statements look healthier than they are.
Or worse. Sometimes it's about showing losses intentionally to meet specific objectives, like making a company look more appealing for a takeover. It's like creative accounting taken way too far.
Exactly, or as I like to call it, creative with consequences. There are so many examples of this, from inflated revenues to totally fabricated numbers. But my favourite bit has to be why people do it. Like, what pushes them to cross that line?
Wow, that leads us neatly into what experts call the fraud triangle, a framework to understand the conditions that foster fraudulent behaviour. It's based on three elements: incentives or pressures, opportunities, and rationalizations.
All right, let's pick these apart. Incentives are those pressures to commit fraud. You have a boss breathing down your neck about meeting impossible sales targets. Or maybe your company's stock is tanking and you feel like you've got to fix things.
Opportunities are the gaps that these people exploit, like poor oversight or weak internal controls. Imagine a company where accounting staff change often, or cash registers aren't thoroughly monitored. It practically invites fraud, doesn't it?
Right, and the third bit, rationalization, is wild, isn't it? It's where people convince themselves that what they're doing is okay. Oh, I deserve this, or it's not a big deal. That mental gymnastics is what makes it all possible.
And when all three, pressure, opportunity, and rationalization, come together, fraud becomes almost inevitable. Any organization, big or small, can fall prey if these factors align.
And somehow it all feels calculated. It's like the perfect storm of bad decisions and timing. Companies, they don't just stumble into fraud, they practically get led there on a silver platter.
And that's where we'll pause for now, but it doesn't end here. Just wait until we dive into some real cases like Enron and WorldCom. Those were true masterclasses in how not to run a company. So, picking up where we left off, Enron and WorldCom. These are prime examples of what we just talked about. Situations where pressures, opportunities, and rationalizations collided in a spectacularly damaging way. They've become textbook examples of greed, mismanagement, and the catastrophic collapse of trust in corporations.
And what's crazy is just how massive the fallout was. Enron wasn't some small-time company. It was considered a titan. They had their fingers in energy, broadband, you name it. And then it imploded practically overnight. Billions of dollars vanished, just poof, gone.
The collapse was jaw-dropping. Enron essentially created shell companies, what they called special purpose entities, to hide their debt. By shifting liabilities off their books, they could still show strong, positive earnings. It was all smoke and mirrors.
So crafty accounting, like we were talking about. And WorldCom, their trick was different, but just as dirty, wasn't it?
Right. WorldCom's gambit was capitalizing routine operating expenses, things like line maintenance, as long-term investments. It massively inflated their profits on paper. I mean, we're talking over $11 billion in fraud. Both of these scandals are prime examples of too good to be true financials unraveling at scale.
And not just numbers on a page. Look at the repercussions. Employees lost jobs, retirees saw their pensions wiped out, and investors. They were left high and dry. It was catastrophic on every level.
Enron alone resulted in over 20,000 people losing their jobs. And let's not forget the investors who trusted these companies. They believed in the financials presented, and those reports were total fabrications.
Yeah, but one silver lining. These disasters sparked a much-needed overhaul, right? Sarbanes-Oxley and all that.
Exactly. The Sarbanes-Oxley Act of 2002, it changed everything. It demanded stricter regulations for financial reporting and audit processes. CEOs and CFOs now had to personally certify their company's financial statements. No more, "Oh, I didn't know" excuses.
Basically, it meant accountability. They couldn't just point fingers at the accountants or some third-party firm. You had to own up to what your company was doing.
And as a young accountant during Enron's collapse, I remember seeing all this unfold. It was sobering. You'd think the role of an auditor was to catch this stuff, but clearly the audits weren't being, thorough. That experience shaped my view on why ethical accounting isn't just important. It's absolutely essential.
It sounds like you got a front row seat to the chaos. Honestly, it's wild how something like that can frame your entire career. Those scandals showed how one bad decision after another snowballs into these mammoth failures.
And the lesson? Transparency and oversight aren't negotiable. Because without them, you end up with disasters like Enron and WorldCom, where everyone loses, except
the folks manipulating the numbers. They made off like bandits, didn't they?
Unfortunately, many of them did. But the changes brought after these scandals were a wake-up call for governments, companies, and even employees. It showed that no one's above scrutiny when billions are on the line.
So reflecting on those massive disasters, we've seen how regulations like Sarbanes-Oxley reshaped what companies could or couldn't get away with. Now let's take that forward and explore something promising. The recent innovations and measures helping us stay ahead in the fight against fraud.
Right, because let's be honest, there's no shortage of new schemes popping up. Just look at the allegations against companies like Adani Group or Luckin Coffee during the pandemic. And, honestly, these aren't isolated cases. They highlight how fragile systems can be during a global crisis.
Exactly, the vulnerabilities exposed during the pandemic were staggering. But they've also driven some significant advancements in fraud detection. Take AI and machine learning, for example. These technologies are being used to identify unusual patterns in financial statements, essentially flagging fraud before it snowballs.
Right, it's like having an always-on watchdog. These systems can process thousands of transactions in seconds, spotting irregularities humans might miss. And it's not just about catching fraud after it happens. They're even helping to predict where it might occur.
That's crucial, isn't it? Prevention over response. But what I find most impactful are the systematic strategies companies are beginning to adopt. Rigorous internal controls, for instance. They can make or break a company's defense against fraud. And maintaining ethical leadership. It's a game changer too.
Yeah, and ethical leadership is such a big one. If you've got a CEO who's all about cutting corners, it sets the tone for everyone else. It's like Arthur Andersen all over again. The "not my job to ask questions" approach doesn't fly anymore.
Absolutely. The Arthur Andersen scandal was a wake-up call, showing that even the most trusted names aren't untouchable. But what's changed since then is that many companies now understand just how costly it is to ignore ethics. They're investing in training, tighter audits, and technologies that bolster trust.
It's like that old saying, An ounce of prevention is worth a pound of cure. The tools and strategies we have today, they're proof of how far we've come. Though, let's be honest, there's always more to do, right?
True. Fraud prevention is an ongoing effort, but at least now we're seeing a shift towards transparency and accountability. And for me, that's the most encouraging part. We're not just patching up the old system, we're actively building a better one.
Couldn't agree more. Innovation doesn't just stop fraud, it restores trust. And that's something everyone, companies, employees, investors, benefits from.
On that note, we hope you've enjoyed this episode on accounting scandals and modern fraud prevention. It's been quite the journey, hasn't it?
Definitely. And hey, if there's one takeaway, it's that staying ahead of fraud isn't just possible, it's necessary. Thanks for tuning in.
And we'll catch you all next time. Take care.